Hello, everyone, and welcome to Beyond the Noise, the M.M podcast, where we cut through the hype and dive deep into the real-world applications and impact that artificial intelligence can have in asset and wealth management. I'm Andrea Sala, and today I'm going to be your host. In today's conversation, we are talking about scaling AI, not just experimenting with it, but truly embedding it within the investment process of asset and wealth managers. Joining me today are what I think are four incredible voices leading this transformation. First of all, of course, in-house guests are Tommaso Migliore, CEO and co-founder of M.M, and Jim Hayes, the advisor for M.M and former CEO of Wells Fargo Advisors. Now, our special outside guests are from EY both, and first of all, here with me alongside is Giovanni Incarnato, who is EMEA FSO Business Consulting, and Urs Palmieri, Global Center for Wealth Management Leader at EY. Thank you all so much for being here today.
It's great to be here.
Good to be here.
Lovely setup, by the way.
So we have a little bit of, a hybrid setting going on. We are here in studio. We also have Jim and Urs joining from all different sides of the world, honestly. So it's great being here today. Of course, to kick off things, we'll take a look what I think are some powerful data points from a recent EY study that was done in collaboration with M.M that sheds light on where the industry really stands today regarding on its AI journey. Tommaso, you lead an AI company that helps asset and wealth managers integrate this type of technology. What does it take to move beyond these AI pilot projects?
So we work on the study, of course, together, and it is a little bit of a funny story because we live in a moment in which AI seems to be everywhere. But yet we are stuck in a paradox where a lot of companies are kind of play with it, but not implementing. I think that at the end of the day, it's the famous sentence from Roy Amara. When there's a big technology shift, people always massively overestimate the impact on the short term and underestimate the impact on the long run. So I think we're living through that. Although that's the situation, there are a lot of companies that are actually way ahead. We support a lot of them, and I think that the key to go beyond the paradox is not trying to experiment. I mean, play around and experiment is fine, but you gotta nail down a couple of areas where you have found good traction, good use cases. There are numbers out there to demonstrate that, and stick with that. And then you plan to do more, right? Oftentimes, when there is a big change, companies try to do all at once. And of course, the capacity, the focus capacity that that a team has to follow a project, to bring it down to the ground, to actually implement it and go in production is always limited. Right? And so if you're playing with a ton of use cases all the time, you struggle you almost cannibalize each other opportunities. So the ones that have been successful, it's because they've been realistic, they've been down to the ground, they started small, they test it out quickly, they trust it, and then they build it up from that.
Jim, you've led these type of transformations efforts inside large organizations. Where are you seeing the highest impact AI use cases right now in asset and wealth management?
Yeah, it's a great question because I'm seeing use cases everywhere. But I would say that two of the highest use cases, the first one would revolve around personalization. What's happening in the U.S. asset management market is the model portfolio marketplace and direct indexing and portfolio customization is just exploding in growth right now. And so if you're an asset manager, you have a larger number of permutations on portfolios than you've probably ever had. And, maybe you're managing around a concentrated stock position, or a client has expressed a preference for not being in a particular sector, or they want a certain weight in a geographic area. And what AI allows you to do is basically personalize portfolios and deliver them at scale, and do it in a way that not only delivers a better experience for the client, but also delivers better risk management, better compliance, better consight. Just a few days ago, I was visiting with a client that has over $1 trillion on their platform. And they talked about using spreadsheets to keep track of some of the customized portfolios. And as you think through that, you think about all the challenges that creates and how AI can help solve that and create a better experience. So that's the first one, portfolio customization. The second one revolves around the end advisor, the wealth management advisor. And I think about two segments. I think about the ultra high net worth advisor, and that person probably has 25 to 30 clients, and each client probably has 4 or 5 accounts, and each of those accounts has a different portfolio. Or I think about the affluent advisor who might have 150 relationships and 4 accounts per relationship for about 600 different portfolios per account. What AI allows you to do is what I call connect the dots, from the portfolio management to the asset allocation to the communication to the end client, and do it in a way that presents sort of a scalable solution on the communication front. And we're seeing a lot of demand for that. And you think about that, like, how do you communicate to 150 clients around 600 different portfolio options and get compliance approval for doing that? And AI allows you to do that. So those are two immediate ones where I see a lot of traction in the marketplace and a lot of opportunity ahead.
So if I may jump in here, because Jim and I are working together on many deals on this thing around these two topics, I think it's very important what Jim has said, right? Because I think we started this conversation by looking at the, if you will, the framework and how we have to say large companies are not maybe too tailored to embrace a technological change so dramatic and profound as AI. But once they do, the opportunities are around the corner. And what Jim has said, and maybe Jim, you can elaborate even further there. But if you think about it, why is so important personalization? Because today, I can buy a portfolio by myself, building it by myself with 4 ETFs without paying a commission to anyone. So as a client, as a retail client, as a affluent, upper affluent, private, ultra network individual, family office, pension fund, endowments, foundation, whether you go full retail or full institutional, why should I pay a fee to an asset or a wealth management company if I can do it myself? Exactly. So at the end of the day, that is what that's where the demand originates from, right? Clients are demanding for a more personalized solution. They're demanding for something that really meets their needs. Okay, and the industry, if we have to be honest, because of the complexity of regulation, digitalization, technology, wasn't really able to cope. Yeah, wasn't really able to cope with that complexity very, very well. But thankfully, we do have an option now to do better. And so maybe, Jim, I don't know if you want to jump in here again, but you mentioned spreadsheet. I know who you were referring to because we were working on that the other day together, and you wouldn't believe the name. But it's a lot of spreadsheet and 1990s technology almost.
Yeah, absolutely. And the funny thing is about the spreadsheets is that they were an effective tool, and they are in some cases, but they're not when you have a certain scale of clients. And most individual advisors have enough clients that they should move away from that. And I think that, just back to an earlier point, this is kind of a little bit of what Tommaso's talking about. The reason people are moving to direct indexing is they want a portfolio that's personalized to them, and they want to own the underlying security so they can be tax efficient with how they basically manage their portfolio. So once you go to that, instead of owning one ETF, you own 150 individual securities. Then what happens is you have to ask the question, well, how do I keep track of all that? And how do I manage around that? And how do I have a tax-aware portfolio? And then when you go and you start to think about the end-to-end process, then you begin to say, how do I communicate to my clients how their portfolio is doing now that I have to comment on 150 securities versus one? And that's where AI can be really helpful. AI is super helpful at connecting the dots from investment research to basically asset allocation to implementation to then how do I communicate to the client around how they're doing? And that's where I think there's a lot of aha moments when we're out in the marketplace. And Tommaso, it's been a fun journey and probably a bigger one ahead.
So, Urs, you have worked globally with so many wealth managers at your position at EY. What would you say are these underestimated barriers? Whether we're talking technical, we're talking strategic, or cultural, what is really holding firms back?
Yeah, first of all, thanks for having me and greetings from the Middle East. The timing couldn't be better for that podcast today because I'm working here with a wealth manager who engaged us to scale AI across the organization. So it's a great timing, and thanks for having me. First of all, I would say we probably all acknowledge that AI goes and impacts, wealth managers beyond the investment process. It really goes front, middle, and back office throughout the organization. And for us, it's very important to establish clarity and structure, the challenges, the opportunities, and also the barriers our clients have. And at EY, we love methodology. So, for example, this morning, we went with our client through a very structured process where we looked at all the dimensions which we feel are relevant. For example, we looked at strategy. So, if AI is a top of the house priority, why do you have only 1%, for example, of your discretionary budget allocated to AI? Or if you want to increase your client experience through AI, how to use AI to improve client acquisition or to improve conversion rates of prospects, for example. Or if you say, okay, AI is a top of the house priority across your organization and the talent group, so do you have the right skills in your organization to kind of like, or the AI enabled roles to implement your AI strategy? So the spectrum is quite broad, I would say. If I would have to call out, what are the biggest priorities or the biggest barriers, I think that the first issue which we see is certainly talent and culture. So even the largest firms, they struggle to attract and retain top talents in that industry. I think that's a big issue when you want to drive innovation and also have a culture of adoption when it comes to AI. And the second also has been gladly mentioned before is, having clarity on your AI priorities and then map that into a roadmap to kind of like build it out incrementally. I think those are certainly the biggest barriers. So talent and setting the right priorities, if I would have to summarize too.
And while you said that right now it couldn't be better timing, you're actually helping a wealth manager being able, to scale this technology. Could you maybe provide an example of what you're doing regarding this? Because super interesting having a real life use case probably unfold right now,
Yeah, obviously I have to maintain client confidentiality, which is clear. But our client here, he has been investing for, I would say, more over a decade into digitization, getting tech stack right, getting data right, and now it's really like how to scale AI with a very particular focus on top line. So it's around client acquisition, converting clients, converting prospects into clients, increase share of wallet of clients. Those are the priorities, and it was really interesting, as we also said before. You can't look at AI in isolation or for a specific team or in a specific silo. So we were essentially working with all the departments of the organization, from HR to finance to risk to technology to data, to the business leads, front office people. So we had in average probably 50 to 80 people in our room because it simply touches every aspect of the organization. So.
Well, that's great. It's great having a real life use case unfold, especially at the time that we're recording this. And I would like to ask Giovanni, relating back to these barriers. Asset and wealth managers, once they have identified these barriers that Urs mentioned, can be cultural, can be technological. What would you say a truly resilient and scalable AI strategy looks like?
Yes, my opinion, first and foremost, asset and wealth manager has to have a clear purpose, and it's important to go beyond the mere operational efficiency scope of the initial use cases, and they have to be focused also on value creation. It's really important also to identify use cases, application where the value is provided also throughout new innovative services to end clients. So in one word, AI becomes a truly strategic levers at par with the other strategic levers that included in the strategic plans of our wealth and asset manager. Having said that, is a truly scalable AI model and strategy is one that sets a North Star. Okay, and backwards, it's important to identify the right operating model, the right governance model, the tech stacks, and also the use cases. So it's important that a scalable and resilient AI strategy should encompass several aspects. Let me outline some of these aspects. Initially, it's really important to identify in a proper way the use cases, based on value, on breadth of usability, to ensure the right business case when scaling up. And it's also important that these use cases and the benefit can be measured by concrete KPIs. Secondly, ensure the right tech stacks. It's really important that we can guarantee good results throughout a good quality of data, and also it's important to put in place and to implement a scalable tech architecture. And also important because not all the capabilities are internally, to identify, to choose the right partner to work with in the case that capabilities are not met internally. Third, adopt the right operating model. And the last but not least, it's super important to build confidence in AI. So we suggest to our clients, to the asset wealth managers, to start and to launch robust change management program, to onboard all the people, all of the organization, and because it's important that everyone within the organization understand the real role that AI can bring or could bring to their work. And it's important also that the population knows what skills need for to properly use it effectively. In conclusion, a resilient and scalable AI strategy is one that looks at a bold, mid-long term goal, and we believe that throughout the right level of investment, the asset and wealth manager can achieve this mid-long-term goal.
Definitely, a scalable AI strategy involves everything from, the people, the technology, the change management, the use cases. More importantly, you have to have a clear objective as to where you're headed in order to know how you're going to implement that technology. And, well, once you integrate it, how does this scalable AI value look like?
Well, I think that the beauty about AI compared to traditional technology is that when you aim at, of course, what we're talking about here is implementing AI to support the investment process. So we have to maybe make a step back. What does it mean? Okay, it's not just supporting investment team, because that's a very important thing, but it's also supporting to deliver a portfolio, to build portfolio at scale, to industrialize personalization, to industrialize the personalization of reporting and the storytelling. So there's a whole spectrum that goes from coming up with that investment idea down to building a portfolio and then telling a story about the portfolio. So in order to scale, so how do you start small and build it up, is we all know that portfolios that an asset and a wealth management company manages, they're not all the same, all in one big bucket. There's areas that you can start with. You can start to play with a little portion of your portfolios, and then it's much easier to build it up. The beauty about being a flexible technology compared to the old school rule-based system is that once you have set it up, the basics, which is the basic integration, then the technology can take care of the edge case much better.
Okay. And, we can really see some tangible value coming up from being able to scale this technology. However, we do have some underestimated barriers to go through in order to be able to fully implement it.
Yeah, sure. So yeah, I've been the past 2 years in New York and worked with our US colleagues, and there are multiple differences. I think one probably starts around my mindset. In the US, you see a lot of thinking around, hey, what's the opportunity? What's the upside? Whereas in Europe, you first start with, okay, what could go wrong? What's the risk? What's the downside? So there's just, I would say, a difference in terms of mindset. And then also, access to risk capital and venture capital is a big difference relative to what I see here. I think in the US, if you have a 10% chance of winning, you take it, because if the one guy out of 10 investment makes it, you will do very well. And in Europe or in other regions, the risk tolerance and the access to risk capital is certainly different. And it was very funny. I've been here with a firm from the US and Silicon Valley, VC funded. The CEO and founder is 20 years old. The CTO is 16-year-old. They have, after 14 months, a valuation of $250 million and work for the US government. They work for like top firms in the US. And we brought them over, and maybe it's the wrong environment to talk about what they do. But there's a lot of innovation going and a lot of creativity going on, which I would say Europe and the Western world here is still a bit in sleeping mode, if I may say so. But yeah, massive differences in terms of culture, mindset, and how to do business.
But I have to say that being European and working with clients, we have about 50 clients globally, okay, and about 20% of our business is in the US. So having that perspective, I think that what Europe has as a problem, and then I'm curious to know what you guys think, but in my perspective, the problem and the opportunity of Europe is that when we look at the application of AI in the financial services is definitely a different framework of regulation. Of course, that's going to impact. But also, it's a geographical divided market. France is not Germany, which is not Spain, which is not Italy, which is not Switzerland is not, but it's definitely not Switzerland, which is not Austria. And although geographically speaking, everything is kind of very close, but these are separate markets with separate dynamics, and especially when we think about asset and wealth management, how much vertically easy it pays off to be vertically integrated from the production from the manufacturing to the distribution, and how much the financial advisors are tied to the banks. That's a difficult environment to scale and to bring innovation broadly, as in the US where it's just one big market. Of course, you have advantages as well, because you have your network, which is closer by to you, which you can control, which you provide tools, so you can facilitate adoption on the other side. So I think there's twofold. Maybe Jim, I don't know, you've been leading at Wells Fargo Advisors, a lot of complexity there. So what's your take on this?
Well, in my view, like all the complexity sometimes can paralyze big institutions. And the best thing an institution can do in thinking through problems like this is just to get started. They say, a long journey starts with a single step. It's all about, it doesn't have to be perfect. Let's develop a use case and let's get started. And as they do that, they'll basically discover, wow, we had a lot of learnings from this. Let's try another use case. And I think that's the opportunity, especially for large institutions. You're better off starting and improving things as you go than never starting.
And how can these large organizations, as Tommaso previously said, it's kind of hard at the beginning, especially for a large organization, to have a complete new approach towards the technology. How can one of these large organizations get started?
Yeah, I think they can get started by just picking a small use case and doing a POC, doing a pilot, getting used to the team and the technology, having some success, and then expanding. Oftentimes, large enterprises can become a little siloed or a little bureaucratic, and Back in the late 90s, there was a very fashionable book called The Innovator's Dilemma by Clayton Christensen. And it was all about how small firms tend to disrupt big firms because big firms sort of get stuck in their own way and they don't challenge the status quo. And that the solution for big firms were to take, 3 or 4 people and put them off the side and have those people disrupt the existing enterprise. Well, basically AI does that disruption for you in a positive way. And so the way a big institution can do it is not to solve, huge problems on day one, solve small problems on day one and iterate and, compound your success by doing another one and another one. The key to it though is speed of execution and compounding very quickly and starting. And that's where I think this team would like to help.
Yeah, really get started, as you said, with maybe a pilot, a small use case, and then, of course, getting beyond the pilot paradox, as the EY paper states. We talked about a little bit the differences between the EU and the US market and how they can get started. Tommaso, you helped several companies now get started, Jim as well, with their AI roadmap. Can you maybe share a recent example?
Yeah, and I love how you say help to get started. It's so true. So a lot of the work that we've been doing, Jim and I and the team together, was really getting started. But I think that you have the same thing, which is, most of the time is just getting started, understand what's the perimeter, etc. So, I mean, the application is, it's pretty clear. There's 3 big areas in which asset and wealth management companies are benefit from AI. Apart from a lot of operational stuff, but that's like improving efficiency, which is, it's like it's a trend, it's happening, it will keep happening, but it's not so transformative. What's really driving top line growth is supporting the investment process, giving more tools, more information to the investment team so that they can see better and cut through the noise. We live in an area where we are bombarded by data every day. So having tools there helps to make smarter and quicker and faster and more informed investment decision. Pretty intuitive. Second area is the personalization demand, which is massive. Okay. And the third area is reporting, telling a story, being able to craft a narrative around the portfolio that it's compelling for the final client, that it's really providing something. Oh, wow, this was designed for me and it makes sense and it's coherent. So the practical application we came across are along these 3 lines, okay? And so these take different formats. It takes supporting the investment committee at the strategic and tactical level, down to providing very deep insight into the investment process. It's creating discretionary personalized mandate, DPMs. It's helping companies, supporting companies to do model portfolio delivery. This is particularly relevant in the US, where asset management companies are providing model portfolio for the financial advisor to take the burden off of them having to build a portfolio. It's supporting the advisory activity within wealth management, creating proposal. But again, with the scope of doing all of these activity at scale. So I think that's the massive difference. Portfolio optimization tool, reporting tool, they've been around many, many years. The difference is that because these tools were very rigid and rule-based, and not as flexible as what we have now with AI, you can only tackle one at a time. Mm-hmm. Here is the scale factor. I believe this is the massive change on thing, is the scale you can achieve by automating things. Now, I don't want to fall into the agentic buzzword, but that's kind of where everything ends up.
Yeah, those are some concrete use cases that we can relate to for regarding the implementation of AI. And once you successfully scale these use cases, that's where the real value lies. And maybe Urs, you are a wealth management leader for EY. You work with global companies. You've seen this several times. How would you measure the business value of AI, and not just cost savings and efficiency metrics, but where does the real value lie?
Sure. I think most important is that firms shouldn't expect a very quick return on investment. I've seen many shiny business cases with an ROI or an ROAI within 3 months or 6 months or 12 months or so. I think that's the wrong perspective certain firms have. I think we all acknowledge that AI is a long-term play. It's like shifting from typing machines to PC or coming from fire in the Stone Age time to electricity. So this just takes a little bit of time. Then the other thing, I think it's important that AI should support business objectives and business strategy of a firm, which are different for any firm. So I think there is no, I would say, value in AI itself. There's only value if AI does support business strategy and business objectives. And then it's all about the nuances every firm has, And for example, here in the region is all about growth. So if you want to double your AUM or you double your assets under reporting, it's about, okay, how can I, for example, increase my prospect conversion rates, or how can I deepen the client relationship and increase my share of wallet, or if I want to shorten the time to market for new products, how can AI support all of this? So I think there's a lot of value in AI, but it should always be linked to business priorities and metrics, and then see how AI can support those priority. And I think it goes across top line, it goes across bottom line, it goes across client experience, it goes across the entire enterprise.
Can I bring a paradox to the table? Because what Urs said made me think about a topic. Most of the time when we engage with companies, they're afraid, but now that there is AI, everybody's going to do the same, right? I actually think that whether you look at, across the business function, actually AI is bringing more diversification, and it allows you to actually personalize your offering way more, because otherwise, you had to have very rigid process that were very similar to one another. You struggle to, yes, the human experience might have been slightly different, but at the end of the day, how much can you scale that? Very little. And so you ended up offering the same thing across the board. So I don't know what's your take on this, but I actually feel that it's the opposite way around. It's not that now that there is AI, everybody's going to do the same thing. It's the opposite. Now that there is AI, you're actually going to be able to offer something different, much better, and have a greater competitive edge.
And I mean, it's an unavoidable step. Like Urs said, it's like going from the typing machine to the computer.
It's here to stay. But again, it takes a different angle than thinking about it's going to be the repetitive things all in all.
Agree. AI application, AI adoption is growing is growing the understanding of the people within the organization. In my opinion, the new frontier is add-on to the application, the usual application to automatize or digitalize the current process. The new frontier is to reimagine the process, to reimagine innovative services to end clients throughout AI. That's the new frontier, in my opinion, because otherwise you can't leverage AI as a competitive weapon, compared to the other clients.
Yeah, I think
it's definitely an unavoidable step. Jim, what were you saying?
Well, I was going to say, I think that's a great point, because when you think about any company, every company has some competitive advantage or secret sauce. And the evidence of that advantage is in their data. Exactly. And so when you look at like the data and you apply AI to the data of that company, what AI really does is it amplifies the competitive advantage that company has. And so I just think it's an accelerating journey that people have to get on really right away, because the disruption cycle, used to be 5 to 7 years, but with AI, it might be 1 to 2 to 3 years. And so it's how do you amplify all the great stuff you already have at your enterprise level?
That is so. Sorry, Urs, go ahead.
No, I fully agree. I think while the technology is, as we say, general purpose technology, the real differentiator is your data and how you interact with the LLMs and the reasoning and all of that. And I think not going into AI is simply not an option. I think that's a very dangerous play, given the implications AI has across the business landscape. So fully concerned with what has been said.
Real differentiator for me is not only data, but also human know-how. Okay, so change management program are critical, are essential, are instrumental to better figure out the future application of AI.
And to give a practical thing, like in where this is happening for real, think about two use cases. One, we're supporting a very well-known wealth management company to do their model portfolio activity, what's in Europe called discretionary personalized mandate. They have a great team within the investment process. They're taking care of the investment process, okay? The super talented individuals. Now, before, that value remained at their top strategy, top vehicle, top funds, and that was it. It couldn't trickle down to the individual portfolio because, how do you do it? You need to hire 500 people, 5,000 people to get the idea, understand it doesn't make economic sense. With AI, you can preserve that investment unity, which is made of their data, their capability of crunching the data, and the human touch, because there's a human process involved as well. But then you can scale it down the line to the portfolio. The same thing happens when you tell a story. You might have a good, let's say, a lot of companies invest a lot in reporting, in telling a story, having a strong narrative. You might have somebody that's really good at doing that. How much do you scale it? And then is it just the same story all in all? What if you can take that capability, both data, human together, and you streamline it down to the individual personalization? So it creates a very good competitive edge. And in a market that, I do agree with Jim, is moving way faster than years ago, it's better to get started sooner.
Yeah, definitely. It's better to get started sooner, and it's an unavoidable step for companies to keep a competitive edge. I think this is a good point to call it a wrap for our first episode of Beyond the Noise. Thank you so much to Giovanni, Tommaso, Jim, Urs. It was definitely a great conversation, super great insights today, and I really appreciate you guys, having a bit of your time over here. I know there's some busy schedules out there. And of course, to our listeners / watchers of the podcast, if you'd like to explore more about, M.M's work, you can check out our website at www.m.m.ai. You can explore some of the actual use cases that we discussed here today. Or if you have any other, questions, you can reach out to us directly over there. If you found this conversation valuable, reach out, and you can also share Beyond the Noise with your network. So until then, thank you so much, and until next time.
Thank you very much.
Thank you.
Thank you.